Good morning. My name is Michael Drew. Today we're going to be talking about options. Welcome. 7 cash flow strategies. Now you likely have been through our class talking about stocks. My guess is that if you've been in either my class or one of the few qualified instructors that have taught our class, you've enjoyed that greatly and you're committed to furthering your education. And I'm just absolutely delighted to be there for you. Now I will tell you this, I get a little excited about options because that's mainly how I trade. I'm mainly an option trader. I do, of course, have long-term positions in stocks, but mainly I enjoy the leverage that is made available through options, okay? So folks, if you're taking notes or you're at home, let's go ahead and dig in. Let's let you know what to expect here today. Number 1, rules for success. We're going to go through a pretty specific process as far as the rules to kind of go by as far as option trading. Reminds me of teenagers. If you're a teenager, teenagers don't need to be taught on how to drive fast. They just know how to drive fast, okay? We need to kind of teach you the correct way. If you bend those rules, that's kind of up to you, but you need to know what rules to bend. So we're going to give you the rules for success. We're also going to kind of go over creating a plan. What portion of your account should options be a part of? What percentage returns can you expect? What is your long-term goal? If you saw the DVDs as far as our first section, I'm big into efficiencies and I'm big into beginning with the end in mind. So if you fast forward your situation here today, I don't care if you're 20 years old or 60 years old or 90 or anywhere in between, where are you going to be in 10 years from now? Part of the reason why I'm so passionate about options is on how they're used and how the people, my mentors, have used them over the past 10, 20, and 30 years. And we'll get into that as we progress through the day. Option basics. Now, through our first day, you learned a little bit about option. An option is a contract that gives you the right to buy a stock, et cetera, et cetera. We're going to go over the basics in detail so you can teach this to maybe a friend or a neighbor, or I hope maybe you can teach this maybe to a son or daughter that you have, because this is going to be a pretty much mainstream way of investing over the next 10 to 15 years and as we progress from there. Forecasting. We're going to talk a little bit about forecasting. Many times I find our alumni students are fighting the trend. That is very difficult to do, all right? Fighting the trend is very difficult to do. It's kind of like a river. If the river's flowing downstream, all right, it's very difficult to swim upstream. It's possible, but very difficult, all right? I'm going to encourage you, folks, to just, trade with the overall market. 2003, the market was generally up. Most of my options were call options. Call options make money when things go up. We did very, very well last year. Is it going to go up in 2004, 2005, 2006? I don't know, and that's not my job to know. My job is to know what tools to apply to what market. So that's where we're going to talk about forecasting and also reading charts. We're going to go over the green arrows and the red arrows. We're also going to give you some support and resistance to how we use those for option contracts. And then really the 7 strategies. Buying call options, when to buy call options, how to buy call options, and when to get out. We never ever get in, this isn't kind of an older wisdom, we never ever get in a business or we never really get in a trade unless we know how to get out, all right? We begin a trade on IBM or Microsoft or GE or whatever you're comfortable with because usually of a specific reason. Either it's a technical or a fundamental or an earnings related reason, we're in a trade for a reason. Consequently, we need to find an exit, and that would also have a reason. I'm mainly a technical trader, so I'm going to talk about the technicals mainly here today. But for example, if a company is, let's just say a drug company, a Pfizer or something like that, or Taro Pharmaceuticals, if a company like this is set to get a FDA phase 3 drug trial approval and a blessing by the FDA that we can go ahead and approve that drug, and if they do get that approval, maybe you're going to trade for that event. When that event happens, then that may be your exit, okay? Whether it's a news event, whether it's an earnings-related event, or whether it's a technical event. We are traditionally in a stock for a reason, all right? In an option trade as well. Reminds me of Yahoo. Yahoo in, 1999, 2000, 2001, don't quote me exactly, but for 12 quarters heading into Yahoo's earnings, the stock would go up approximately 20%, sometimes 30%. Well, after you leave here today and you have some of this wisdom, and especially as you meet our coaching department, which is an excellent department, you're going to learn that a 20% move on a stock could fairly easily create almost a 100% move on an option. Just think on what that could do for your portfolio. 4 times a year, we take a small amount of our investment capital and we double it. Imagine what that could do long term. So we're not quite there yet, but I want you to be open to continually shifting your paradigms, okay? Next, buying put options. That's not very American. We're used to buying things that go up, not necessarily buying things that go down, but put options have been a fantastic way to make money on the downside. Now, many of you folks have been trading for quite a period of time, and in fact, if you're sitting at home, maybe you've been in the market for years, maybe 10, 20 years, and you, like most Americans, have 401ks. And if you're standard 401k, how do we make money in a 401k when the whole market's going down? Well, it's difficult, right? Maybe you have a choice to a beta negative mutual fund that makes money when things go down, or a bear fund. For example, Vanguard has bear funds that are beta negative, that trade downward or short stocks. But that's a little bit difficult. If the market heads up, if the market trades flat or it goes down, we can still make money. And think of that as a business. We had in fact, right in the front row, I remember this like it was yesterday. We had 3 people who owned, it was a joint venture that owned a franchise. Has anybody ever heard of Sylvan Learning Centers? Gentlemen, have you heard of those? I've heard of that, and I like that business, okay? And they were in this business, and they said, well, listen, we don't know how to get out of this business. I mean, the only way we know how to make money is in this franchise. I said, well, what is your exit strategy? I mean, how are you going to get out? And they had no idea, all right? So when we're talking about this today, I want you to kind of think in the long term. What business that you're in, whatever it may be, and how we're going to use that. I mean, ideally, what I would think is eventually you would sell that franchise. That would make sense to me, build it up and get a good clientele or whatever's necessary to improve that franchise and ideally sell it for more than it was worth. Well, that said, at age 40 or 50 or 60, then what would you do with the capital? Some people would invest it in real estate. Real estate is a fantastic opportunity. I enjoy real estate. I've noticed, though, the realtors and the real estate investors that come to our class realize my investments and my assets are tied up in real estate, yet they're very, very non-liquid. They've said this before, I'm asset rich and cash poor. And that doesn't sound like something that I'm personally interested in. I'm interested in being both, right? Asset rich and cash rich. So that's where we talk about cash flow. And that's when we talk about our covered calls. Covered calls will talk to us about cash flow. If you remember our DVDs from yesterday, we have number 1 word of money is cash flow. Number 2 word of money is leverage. And I'm all about them both. All right? Those of you who are invested in real estate's a great investment. Ideally, it's for cash flow. You'll also want capital appreciation, right? But I'm very, very interested in cash flow. Very rarely do I get into a property that doesn't have monthly cash flow. All right? And that's where we'll be using covered calls, and that's how we're able to retire hundreds of our students, is we teach them how to pay their monthly bills. That can be done through our covered calls. And we'll also talk about how to find stocks to do covered calls. Literally, there's only, about 20 to 25% of the stocks out there that are even capable to be used in a covered call environment. So we'll teach you how to use and how to find those stocks. Next is our LEAP section. LEAP stand for Long-Term Equity Anticipation Securities. That is a favorite one of my strategies, and here's why. It is what we call almost investing by proxy, or derivative investing. Instead of investing $30,000 on 1,000 shares, we may invest, 6 or 7,000 and control that same stock maybe a period of up to 2.5 years. Okay? So we have a lot of leverage available here to you. And lastly, we're going to talk just briefly about exchange-traded funds, okay? And that is a kind of been tools that have been out there for a little while that have pretty much changed the way we invest. Previously, we would invest in mutual funds, and those are a great way to diversify your monies and your investments. Now we're going to use some index tracking stocks and some exchange-traded funds. So let's dig into it. The business of investing, trading versus investing. Many of you folks have heard, buy a stock and hold on to it for the long haul, right? What does long haul mean? If you don't know what it means, here's what long haul means. Long haul means you're going to buy it and hold it because you don't know when to sell, okay? That's what long haul means, all right? Maybe your brokers have said the same thing, hold on to it for the long haul. Here's the new kind of, let me give you some new wisdom. I'm going to hold on to it, and I like long haul. I mean, I ideally would like to buy a great stock. I'd like to then hand it down to my child my children, and I'd like them to hand it down to their children, and we own the stock in the generations to come. However, is that reality today? Yes or no? No, absolutely not. So here's the new wisdom. Folks, I'm in it for the long haul or until it drops. Does that make sense? I don't need to participate in the downward moves. We now have tools available to us that will help us so we don't have to participate in that, all right? We need, and by the way, what we need to give in order for that to happen is we need to have a little bit of desire and a little bit of sweat. All right, a little desire and a little bit of sweat. If you don't have that desire and a sweat, then you'll have to, endure the ups and the downs. If you just run with me, run with your personal coaches, and just be interested in your money a little bit more and see how it can, benefit you and your family. Just spend the, 15 minutes, every day or a few times a week. You will be, your knowledge level will go up, your confidence will go up, and your apprehension of investing in the market will go down. All right. Next is profit from your trades. I know that's pretty basic, but we're in option trading for one reason and one reason only. That's to make money. That's it. We're not in it for the long haul. We are in it simply to make cash flow. Next, to know your tolerance for risk. Now that's kind of near and dear to my heart. I kind of enjoy risk a little bit more now, but let me go back. Folks, I didn't really enjoy this when I first started investing. It kind of reminds me of this. A plane. We have maybe some private pilots. There's always some private pilots in our workshop. If you take that private pilot and you take a look, he launches his plane and he's up in the air. He can make very, very few mistakes. He or she can make very, very few mistakes if that plane is right above the trees. Would you agree? Because if there's some wind or a miscalculation, or I'm not a pilot, or whatever happens, maybe in a mistake, and that plane hits a tree branch, we're in trouble, right? All right? Some of you folks are right there almost in your life. I know that because I was there about 10 years ago plus. I thought I was doing okay. Then when you really look at your financial statement, you're really, your net worth isn't where it should be. Maybe you feel that you're behind the 8 ball, and maybe you feel like I did, is that I should be worth more by now. I'm a bright guy. I take care of my family. I believe in being a good person. Why do I have this credit card debt that I did 10 years ago? Why? And I realize it's just a function of my education. My parents never taught me. So again, knowing your tolerance for risk. If that plane is on the tree line, our coaches will understand that, all right? And our coaches won't recommend things and give you ideas that will be very volatile. But once that plane rises, 5,000 feet if it's a small Cessna, or if you're flying a jet, of course, much higher. When you're up in the air and let's say you've invested, using round numbers, $10,000 and now you have $5,000 of the market's money, can you then afford to be maybe a little bit more risky on the market's money? Does that make sense, folks? Yes or no? Yeah. So that's really what we want to do is let's get consistent. These trades, kind of like I used the analogy of the first 3 batters in the lineup. Let's get consistent with our trades. And then when we have a little bit of profit, let's learn how to be maybe a little bit more risky. And let's be honest, if you are in your 20s, 30s, and 40s, and you haven't taken any risk yet, and you have $10,000 to your name, are you going to be able to retire in 10 years? Probably not. If you graph, you're 20 years old, now you're 40, and you only have $10,000. No problem. You are, wherever you are, that's where you are. That's fine. But let's do something different so we can get somewhere else. So that's where we're talking about a little bit for your tolerance for risk. Don't get greedy. Literally, it should be fairly non-emotional. Now, we're going to treat this like a business now, okay? This is not an introduction to investing, okay? This is not, we know you're going to be with us. We know you're going to be with the toolbox for a while, and we're going to treat you like that. We're going to treat you with kid gloves. We're going to take care of you. We're going to answer your questions, but we want to recruit you over to more of a logical camp. We're going to make a decision because of these reasons. We are going to sell because of these reasons, not because I have warm fuzzies and I should own the stock, okay? We're gone. That's our exit, or that's our stop loss. That's it. We're fairly non-emotional, and that's how a business owner should run their business, right? For example, if I use this analogy, let's say you're in a trade, whether it's a stock or an option trade, and it's losing money, and it reaches your stop loss point, okay? That is the line in the sand that you say, hey, if it hits this point, I'm gone. What would you do? You would sell, right? Reminds me of if you were to own a franchise. Let's say we have a couple of our students, I remember they owned a Subway franchise. If you've heard of Subway shops or Quiznos shops, okay? They own a Subway franchise, and let's just say you were to do the same thing, and you hire somebody to come work for you, like your family member, like a brother or sister, or I don't know, a niece or nephew, or something like that, okay? They come to work for you, and then all of a sudden you turn the corner, and you see them in the cash register right before they leave, and they're just taking a couple 50s and a couple 20s and putting them there in their pocket. And you say, hey, you know what, I'm confused. Help me understand, what are you doing? And they say, oh, I'm just taking some cash flow. I'm going out this weekend. And they say, well, is that, that's wrong. You can't take the cash out of the register. And they says, oh, of course I can. I'm family, okay? And then they say, and by the way, I plan on doing this next week, the week after, and the week after that, and I don't know when I'll stop. All right? Now, as a business owner, what would you do? You would probably, even though you may love your relative and you may feel, warm fuzzies on your relative, a true business owner would have to say, we're going to need to disassociate, okay? We're going to need to cut ties. That's not healthy for the goose. So you folks you're here because we know that you have a long-term time perspective. Treat this like a business. Now that said, if you treat this like a business, and let's fast forward this. 10 years from now, you're going to go ahead and let's say you have a 6, 7, maybe 8-figure account. I don't know. You're going to be, fast forward this, you're going to be delighted that you rolled up your sleeves, that you prepared properly for your coaching sessions, and you were involved. 10 years from now, when you have several hundreds or several millions of dollars, whatever it may be, and you realize that you don't have to work, you're a full-time parent or you're a full-time philanthropist, whatever you want to do, you're going to realize, gosh, I'm happy I spent the time that I learned on how this works. I know I'm going to be investing for the rest of my life. So that's a little bit about getting greedy. And if you'll see here, it says know your exits. Not just exit. Look at the plural there. Notice, know your exits before entering a trade. We'll talk about that when we talk about sell stops and also our profit targets. Underneath that, use only a small part of your portfolio. Options are risky. Don't let anybody tell you they're not. Driving a car is also risky, all right? Owning stock, that's also risky. Part of the reasons why you may have heard in your past history that options are risky is options, it's kind of like stock. Let's say we have a stockbroker who sells stocks, and we have maybe a commodities broker and a futures broker, and then we have an option broker, okay? You only have finite money, right? I only have finite money. And if I invest in stock, that very well may preclude me from investing in options, yes? Okay? So even though the moguls, my mentors have used options for years, they've gotten educated, some people who are a stockbroker, they may say, oh, don't do that, it's risky. Or futures, oh, don't do that, that's risky. Or, don't do currencies, oh no, that's risky. Buy stock from me. By the way, who gets the commission? I do. You with me on that? So I want you to have more of a long-term perspective and be educated. I'm mainly an option trader. I do also trade stock, and I'm not that experienced with futures or commodities. I've had my little forays there, and I've decided to kind of get really good at what I'm good at, which is this business model, okay? And then on the bottom here, I've kind of mentioned that. Treat this like a business, and it could pay you like a business. Treat this like a hobby, it'll pay you like a hobby. Now, my goal is to kind of recruit you over to the business mindset. Now, that said, if you're only interested in a few $1,000s a month, maybe you don't need to treat this as seriously as I do. That's fine too. If you're interested in higher cash flow, give it a little bit more time, a little bit more sweat, and it will take care of you, all right? Your personal trading plan, it says have a trading mission statement. Use conservative option strategies to generate 5 to 15% monthly cash flow and never lose more than 50% on any single option play. Now, when it says 5 to 15%, that is per trade. That's not on your whole account, okay? That is per trade. So if we have a trade that's making 5 to 15%, that would be our goal. Also, our goal is to never lose more than 50%. If you're holding past 50%, that's called denial, all right? That's not a river in Egypt. That's bad, okay? That's our line in the sand. Also, if you're you develop a relationship, as you will, with your coaches, or maybe you've met some people who have taken advantage of this options and the discounts we have available here, is I would totally encourage you folks to meet and greet other traders. Find people who are doing well in this, and you guys can grow together. Have the abundance mentality and share your trades. Next is your personal trading rules. All the lessons you've learned from the bad investments you made in the past. Friends, I'll tell you this. The ladies and the gentlemen that I trade with, okay, now they're across the world. We used to kind of trade just in Chicago, and we've kind of grown up and moved on, and I live in the Columbus, Ohio area, and a gentleman that I traded lives in the Seattle area. I've got a gentleman now I trade with, he lives in Guam, so he trades, I believe, 11:30 at night till 6 in the morning. I can't remember exactly, but anywhere you're at, okay, every option trader that I've traded with keeps a personal trading journal. Now, it's a trading journal. We don't call it a diary because it just kind of feels weird if you say it's a diary, okay? But it's a journal. So we go in and we say, hey, this is where I've improved and this is where I've made mistakes. You would do this if you had a long-term time perspective, right? So you would look back on your journal and say, wait a second, why am I so, I'm so bullish on semiconductors? Why am I, I keep buying these drug stocks. Why do I keep doing this? Am I making mistakes? You can troubleshoot yourself if you keep a trading journal. I'm going to encourage that. All you'll need to do is basically give you the criteria of your trades. So, I bought Y, I sold Y, and then an own paragraph. Mine looks like this, February 1st to 2000, whatever. I made this trade because of this. My exit strategy was this. And then my exit. Wow, I made more money than I thought. That's usually how it looks. That's what I like. Or, I may have gotten stopped out because of a news event. We can't control news events, right? Whatever reason. Note to self, do this. Note to self, but you know what I mean? And then I can just read that. Every month I read those, and I'm sharpening the saw. If you remember, I'm a big fan of Stephen Covey's 7 Habits of Highly Effective People. Habit number 7 is sharpen the saw. How are you going to get better unless you know where you're at now, all right? So trade the trend. We're big trend traders, which means we trade with the market, we trade with the sector or the neighborhood or the industry group that it's in, and also the stock. When those three are congruent, let's go. That means we have a good possibility of making a profitable trade. Trade long calls on uptrending stocks and trade long puts on downtrending stocks. Long simply means you're long. That means you've bought the call or the put. Let me review a little bit from maybe your stock class. Remember, calls make money when things go up. Puts make money when things go down. Easy way to think of it is a phone call. Call up, put down. Call up, put down, call up, put down. All right? That's it. So long calls mean we would go long. We would buy calls on uptrending stocks, and we would go long puts. We would buy puts on downtrending stocks. Now, we'll start out this day talking about the definitions of options. We'll then go over calls. Calls I understood. I like calls. Buy American. I like buying things that are going up. Puts, I'm not the brightest bulb in the box, but I tell you, puts took me about 2 weeks to understand. To get my arms around that took me a while. I would look at it, somebody would explain it, and I just couldn't. It took me a while, all right? And so that's why we have this on DVDs, and your coaches will walk you through this as well, all right? Long puts on downtrending stocks. Always have a stop loss, either mechanical or mental. Ideally, I'd like it more mechanical than mental, but we'll always have a stop loss. Again, let me reiterate what I've said previously to my workshop classes. Of the book that I read of the 10 most successful traders of our decade, they say the 2 things that they do. Number 1, they always have a stop loss. Number 2, ideally, they sell too soon, which means they do not hold on to the stock, wait for it to drop. They sell too soon, all right? They enter passively. They enter, kind of,